Do you know what connects sharp market sell-offs and unexpected upside reversals? Something usually precedes them. In today's video, we'll take a look at the most reliable leading indicators to help you recognize that something major is changing in the markets and before others do. We'll focus on US indices like the S&P 500 and also the European DAX. We'll look at both macroeconomic indicators and technical signals to show you what really works. So let's do that. Macroeconomic indicators. The most important leading macro indicators include the yield curve, PMI indices, consumer confidence indices, new unemployment claims and composite leading indicator indices. For example, yield curve inversions, when short-term rates exceed long-term rates, have historically preceded recessions and stock trend reversals. PMI indices, ISM in the US, market or IFO in Germany, record expansion, above 50 points, or contraction in production and tend to be reliable in estimating economic growth. High PMI readings usually signal GDP growth and stock growth, while a sharp decline in PMIs risks a bear market. Consumer confidence, e.g. Conference Board CCI in the US, focuses on expectations for the economy and household spending. Although measured imprecisely, it correlates with consumption and thus with stock prices. Weekly new claims for unemployment benefits increase when the labor market weakens. A sharp rise in these claims typically signals an impending economic downturn. In the US, this report is being watched as a short-term warning signal. In Germany, there is not much of a weekly analogy. Instead, the monthly unemployment rate or Eurozone indicators are monitored. Leading indicators also include composite indices such as the Conference Board's US Leading Indicator Index, LEI, which, by aggregating 10 components, including manufacturing orders, the stock market, consumer sentiment, etc., forecasts the turn in the business cycle roughly 6-9 months ahead. Similarly, the OECD publishes its Composite Leading Indicators, CLI, for the euro area or Germany, which monitor industrial production, order book, confidence indices, ZFGI, IFO, and others. These indicators, if they show a prolonged decline, often precede a fall in stock prices. In general, the aggregate of multiple indicators going in the same direction gives a stronger signal, e.g. when PMI falls, industrial layoffs and yield curve inversion increase attention to the change in the equity trend. These macro indicators have similar functions in the US and the euro area, but reliability varies according to regional specificities. US yield curves, 10y3 meters, have long preceded US bear markets, while in Germany they are more influenced by ECB monetary policy and euro area-wide bond demand. Germany's PMI may be more sensitive to global trade than the US ISM PMI. German industrial indices, IFO, ZU, are often correlated with the DAX, but may only indicate a turnaround after some lags compared to US indicators. Similarly, US data is followed immediately by market participants, e.g. weekly unemployment insurance, whereas European indicators come less frequently. Technical indicators. Frequently used technical tools for detecting trend changes include RSI, MACD, Bollinger Bands, volume changes, moving averages and divergences between price and the indicator. The RSI, Relative Strength Index, is a momentum oscillator that measures the size of recent gains versus losses over a given period, usually 14 days. An RSI above 70 indicates an overbought market, possible slowdown in growth, correction, while below 30 indicates an oversold market, possible bounce up. The RSI is often used to look for divergences, for example, when the index reaches new highs but the RSI does not reach new highs, called negative divergence. This can signal weakening momentum and an impending trend reversal. Similarly, a positive divergence, price makes a lower low, RSI a higher low, can indicate a bottom and a reversal to the upside. Technically, the RSI is a simple code indicator for overbought, oversold conditions that can be caught early. But like other indicators, it is not 100%, it is often used in combination with other signals. The RSI reacts to the volatility of the instrument, and so can generate more false signals in the lower volume DAX index than in the more liquid S&P 500. MACD, Moving Average Convergence Divergence, is a momentum indicator based on two exponential moving averages, 12 and 26 periods. It is calculated as the difference of the faster EMA 12 and the slower EMA 26, and a 9-period signal line, the EMA of the MACD, is plotted above this curve. The intersection of the MACD with this signal line can indicate a change in trend. An intersection from bottom to top is considered a buy signal, while the opposite intersection, MACD crosses the signal line from top to bottom, is considered a sell signal. Also, the histogram itself, the distance between the MACD and the signal, can indicate the strength of the momentum. The MACD generates signals similarly for all markets. Its crosses on the Dow or S&P, for example, tend to be interpreted as a continuation or reversal of an existing trend. Studies document that simple MACD rules can historically produce abnormal returns in selected markets, including the US Dow. Similarly, the RSI, with modified settings, has shown gains in the Dow. This suggests that these oscillators may have acted as robust signals in their respective periods. However, the same principles apply in the German market, although the DAX tends to be less volatile than the Nasdaq. In practice, MACD and RSI are used analogously and their signals need to be verified by volume indicators. Bollinger Bands consist of a central 20-day moving average, SMA, and upper and lower bands, usually plus or minus 2 standard deviations from the SMA. The width of these bands changes dynamically with volatility. The bands widen at high volatility and narrow at low volatility. A narrow band, called a squeeze, signals low volatility and the deposition of energy into a stronger move. The breaking of this squeeze often portends an early strong price swing. If price breaks through the upper or lower band, it indicates a statistically extreme condition. A touch of the upper band implies overboundness, potential for a downward reversal, while a touch of the lower band may indicate oversoldness and an upward reversal. Bollinger Bands are therefore used to measure volatility and identify overbought, oversold conditions in both markets. The principles apply similarly to the S&P index and the DAX. Moving averages, MOS, especially the intersections of differently set averages, are classic indicators of trend reversal. Commonly used are short-term, e.g. 50-day, and long-term, 200-day, averages. The intersection of a short MA above a long one, the so-called golden cross, is interpreted as a buy signal and the possible start of a bullish trend, while the intersection of a short MA below a long one, the so-called death cross, signals a sell signal and a possible bearish reversal. For example, the intersection of the 50-day MA over the 200-day MA in most cases led to a continuation of the market growth. A similar cross applies to any chart and the same principles are used on the DAX and S&P. The lesson is universal. However, in Europe, less liquidity, stronger influence of individual stocks, there can be more false crossings, so MOS are often combined with other indicators. Trading volume is not a traditional indicator, calculated from formulas, but is critical for trend validation. Investopedia notes that without strong volume, price movements tend to be considered less valid. When a trend is confirmed, price and volume should rise in sync. If price is rising and volume is falling, it is a sign of weakness in the movement. Conversely, a sharp increase in volume when price is falling is considered a very bearish signal and may indicate a confirmed distribution. A disparity between price and volume, e.g. rising price plus falling volume, raises suspicions of an impending reversal. These principles apply to both markets. Investors watch volume oscillators or indicators such as on-balance volume and are given great emphasis. However, on the DAX, where the average volume is lower than on the S&P, some volume extremes may give a different meaning. In general, no technical indicator is absolutely reliable. Studies show that a combination of indicators increases success rates. For example, investment research has found that strategies based on MACD and RSI have historically generated abnormal returns in selected markets, S&P, Dow, Toronto and Italian stock market, suggesting their ability to identify reversals. However, results vary by market and time period. In the US environment, technical analysis has a long tradition in high liquidity, while European, and thus DAX, markets may react differently to fundamental news. For example, the DAX is heavily influenced by global trade and European politics, so some signals may be delayed or less pronounced than in the US. Overall, macro and technical indicators work similarly in principle for the S&P 500, Nasdaq and the DAX, but their interpretation and reliability must be adapted to local conditions. Each indicator has its own strengths and weaknesses and none provides a 100% guarantee. In practice, multiple indicators, both macro and technical, are often combined to confirm each other's signal. While macro indicators reflect broader economic cycles, or their reversals, technical indicators work directly with the price chart. Historically, the inversion of the yield curve has proven very reliable in indicating an impending economic downturn, and subsequent stock declines. And the RSI, MACD can pick up potential changes in trend momentum. However, in the different economic and market conditions of the US and Germany, these indicators may exhibit different performance, hence the need to consider the context of the specific market and supplementary data when interpreting them. Thanks for watching, and if you liked the post, give a like and subscribe to the channel.